We're live. We are doing our 4-part educational series on learning to underwrite multifamily commercial real estate. This week, what we're doing is diving into the PPM, which is the Private Placement Memorandum, which you can see here. That is basically the legal disclaimers that are designed to make you fully aware of all of the risks of the deal to make sure that you know exactly what you're getting into. And this would be the same that you would need to sign if you were investing in any private company, not just real estate, but any kind of private stock. You're buying a security. And so that comes with a lot of rules that the issuer needs to comply with from the SEC. And that includes the Private Placement Memorandum, the PPM, or legal disclosures. So let's just dive right in. There is a lot to cover in a PPM, and I think it's really easy to get caught up in the weeds. And so we're just going to cover the highlights. The biggest thing I want to convey is that experts are going to put together your financial pro forma, people who have finance degrees and a lot of experience doing financial analysis with large companies. And sometimes it makes the spreadsheet a little bit inaccessible and hard to read. And the PPM is no different. It's put together by highly trained and specialized attorneys. And it's not designed exactly to scare you, but it often does have the result that there's a lot of fear when you're going in to sign this. It's the first time you've ever read it. And I have had a lot of people express that they've either lost investors or an investor doing their first private placement, that once they read the PPM, they actually backed out, because even though they felt like they had maybe a decent handle, that it was a good deal and they liked the team, this document can be incredibly intimidating, either because you don't know how to read it, and if you feel like you can't read it, then you can't possibly sign it, or they start reading it and they get really lost in the weeds and the details and the explanation of all of the risks, and they feel like, oh, wow, this is really risky. I don't know if I can get involved in this, and so they won't be able to sign it then. Then you have all the way to the other side where people will say, I don't understand how to read this, but I'm sure the team is great. I'm just going to go ahead and sign it. They just click next on the e-sign document, next, sign, and they really don't look at it. They don't know what's in there, and they're just trusting the operators that they're going to have good customer service, and they're going to want to get your repeat investing business, and that you're not going to look at this kind of stuff. If it's the first time you are investing with a group, it's definitely important. You need to read every single page of this. If you are an aspiring syndicator and you would like to do this as a business, especially if you're going to be raising capital, I recommend that you read every single page multiple times. Get yourself a sample, maybe one that you've participated in as a limited partner. Really get familiar with this. It's just like learning a language. You're going to have to write down notes to look it up. You're going to have to ask your attorney for help. This can be a lot of study and it can take a lot of time. Yet at the same time, there are some key red flags that we're looking for on a first review. And especially if you're getting pretty good at reading these. I asked some attorneys, I said, how do you stand reading all these documents all day long? This is what you do, is you read boring legal documents. And they've told me, you just learn how to skim, which sounds really terrible, but there's no way you can make it through all of these every single time unless you really enjoy this. Most people hate this part, which is why lawyers are more of a specialized profession. So let's just try and get into it, and with the spirit of we're going to be empowered, learning how to read this rather than scared and intimidated, because at the end of all of this, what we want to do is invest in a project, invest in something where we feel confident that we're going to get a good return on our money, and that we're not going to have problems and legal loopholes that people are going to be trying to jump through to basically cheat us out of our money or cheat us out of our returns because they've disclosed it, but we didn't bother to read it. And I think that if you're going with a team that you believe in their customer service, you believe in their degree of professionalism, that would be great, especially if you've invested with them before. For the first one, you really do need to check it out because sometimes they will slip things into the PPM. That's why it's called disclosures that might not be more publicly obvious. Do we have any questions on that? At first, has anybody ever invested with the PPM and read it and felt scared to sign because it talks about all the ways you could lose your money, like God could come down and burn your apartment up, or a giant wave could swallow it? It does really feel intimidating sometimes. Does anybody have any experiences that you've had along those lines?
The same way when you buy your first house, do you read that whole thing all the time?
Yeah, it's terrifying.
Yes, it is terrifying.
Hey, my experience was previously with more tech PPMs. Like one of the things that I ran across in the one that we've done here is the same thing as a lot of times they go into arbitration and how you settle disagreements and things like that. And it seems like that's really important to cover, because a lot of times you will, if you do have a disagreement, you have to go to their home state, or there's a mediation firm that they've already named, things like that.
That's a good point. I think in a joint venture, it's really important because if there's any kind of dispute, you definitely have to show up at court. And we have had to change the venue on joint venture agreements. You're not going to have as much power to ask for changes on the PPM, especially if you're a limited partner just putting in 1 or 2 units. If you are coming in, say, with our club where you're bringing in $1 million and you see something that is concerning, there is something that you can do called a side letter. And if you are bringing in enough cash or bringing in enough influence or resources or whatever it is that they would be willing to work with you, you could get a side letter excusing or changing some of these things. We have had operators change the PPM, tweaking it at our request. So if there's something you see that you're uncomfortable about, ask about it before you just say, I'm uncomfortable with this, I'm going to back out because of that. Question you should be asking yourself is, if this operator could wave a magic wand and fix everything about this deal that I don't like, that then I would invest in it, what would those things be? And if you just write them down, you'll be able to zero in on what exactly might be not sitting right with you. And then that's what you go to the operator and ask. If they're not able to wave that magic wand and fix that issue for you to your satisfaction, either because they are unable to, let's say it's a market condition, they can't change the loan or market conditions and you just don't feel comfortable, that would be a reason to not invest. But if they can wave that magic wand, what exactly would those things be? And that's when you have a little list of things you might say, this is in the PPM, can we change this? Can we change that? Or can you provide some clarification? The offering memorandum or the pitch deck that we looked at in week 1 is included in the PPM. That is part of the offering. So if there's some disagreement between the PPM and the deck, typically the deck will win out because that is what they presented to their investors as their advertising. So if there's a disagreement, you definitely want to ask about it and see if you can have those things match up. The pitch deck will be in the PPM, or at least select pages will be part of this document. So the issue at the beginning, pretty straightforward. They're telling you how many units are in, or how many dollars are in each unit. So for example, you're going to have $1,000 per unit, 4,600 units total for $4.6 million. At that point, this subscription will be closed. They can no longer accept any more capital. The capital that they do accept will go straight into the bank account that the LLC has set up. So you will wire directly to their bank account. Because these legal documents are used when they're set up the bank account, that means that they can take money from limited partners, or they can sell securities to people who want to buy those company stocks. And that's when the cash will just go straight into their bank account. If they don't have these documents that they sign and they put cash straight into their bank account, they are in violation. So just make sure that they're following the correct path of how these things should work. Obviously confidential. We're not going to go through every page of this. This right here, they're starting to have the risks and representations. So they're basically saying that nothing is guaranteed. These are just projections. They do expect to get these returns, and you'll see those returns, that stated IRR, will come up repeatedly in here. But at the same time, it'll always have the disclaimer that no assurance is made that this IRR or these returns will be achieved. This is just what the operator expects. So you have to rely on your own examination of the fund, the terms of the offering, including the merits and the risks involved. This is the same rule that we have in the club, because we don't have limited partners in our club. We are a joint venture club. We have to have every single investor reading this PPM individually and making sure that you feel comfortable to sign it, even though you're putting cash in the deal under the limited partner designation, because we are going into this as a club and we don't have limited partners inside of our club. You really do need to be able to make your own decision. A lot of people will be led by the group. Oh, if you feel comfortable with it, I feel comfortable with it. That's up to you. You get to decide if you're comfortable with that or not. And you need to be able to assert that you made your own decision. Everybody just has a different level of comfort when they feel like they're ready to make that decision. So an investment in these securities is suitable only for investors who have sufficient knowledge and experience in financial and business matters to evaluate the merits and risks of the investment, and who have the financial means to bear the economic risks of this investment. Now, this is a 506C syndication, meaning it's for accredited investors only. And that fund will allow an unlimited number of investors and an unlimited amount of funds that can be raised. But you can see at the beginning, they are going to state exactly how much they're going to be raising. And this is for one single project. Some PPMs will have 2 or 3 properties in the same PPM. That's basically a fund. And this one would be called a single offering. And a fund will have usually multi-unit or multi-project offerings. So it will go through and say how much they can raise. So even though this type of fund can raise unlimited funds, they have capped this particular one. Each one will have its own particular cap, at which point that raise is closed. They usually have 12 months to accomplish that raise. So just read through these disclosures. I feel like they're fairly self-explanatory, written in fairly plain English, and they're also fairly vanilla. You're going to see the same types of things in every PPM. It's compliant with the Securities Act, that there are the risk factors, that you understand that this is private and that you have the ability to make this decision on your own. Raquel asks, when do you consult your attorney when it comes to a PPM? PPM stands for Private Placement Memorandum. The answer to that is anytime you feel like you need the help from an attorney to understand what's going on, especially if it's your first time. Let's say you're going to put in $50,000 and you might need to pay an attorney for an hour of his time. Most attorneys are not going to cost you more than about $400 an hour. So if you are looking at 1 to 2 hours and you're in the $250 to $400 an hour range, you're really looking at less than $1,000 to have this reviewed. If you're putting $50,000 into a deal and you're asking your friends and family to put in $50,000 units into this deal, there's no reason that you should forego consulting an attorney, especially if you need it for peace of mind. I don't know if I would feel like I needed to consult an attorney on every single PPM. Certainly the first one I ever did, I was the sponsor on the deal. And so we worked with the attorney quite a bit to get it drafted. And so I was able to ask a lot of questions. If it's your first time looking at one, you would never go wrong with consulting a securities attorney, at the very least a real estate attorney, to advise you on the risks of this and just make sure that they're compliant. And if they're trying to hide anything in the disclosures, that your attorney would be better able to pick out those risks than maybe you would be untrained. The next question is from Rogelio. He says, attorneys often work off of boilerplates. They can fail to incorporate specific provisions that the operator wishes to be incorporated as per the business plan. That is a great point. A lot of the inconsistencies that you're going to see between the PPM and the offering memorandum, or differences in what they said in the webinar, and the webinar is also submitted to the SEC if there's ever a dispute, what you said in that webinar can and will be held against you. So what that operator tells you in their official communications, it all counts. It's not like they're going to tell you something and then they're going to hide it in the PPM and it's actually different. All of the documents that they send out are subject to your approval, and they have to be honest in all of them. And there are different kinds of funds. For example, a Regulation A fund, they will look at all your social media, they'll listen to all your podcast interviews, and you have to submit audited financials, and they will really look at it and keep you on track. So everything that you say and everything that you assert can make you, the operator, be held liable. So again, if it's off of a boilerplate PPM that the attorney just pulled out, he's going to miss things. And those are the kinds of things when I'm asking for error correction, sometimes they'll go back and they will fix it. But a lot of times what the operator asserted is going to supersede anything that's in here. Again, if there are a lot of problems with it and a lot of inconsistencies, I definitely would see that as a red flag. A couple of them is pretty normal. But if there are a lot of them, definitely draw it to the attention of the operator and understand when the operator responds back and says, oh, well, this was what we put in the deck and that's what it is, that actually is a legally binding statement, that what's in the deck they're going to be held to. Sometimes you have a look at this, different states might have different rules. And so they're going to put those in because this is going to be offered nationally. And it's going to be offered to a lot of different states. Every single state has its own SEC. And the nice thing about these 506D or these Regulation D funds, like a 506B or 506C, is they supersede state law. So if the federal SEC says something and the state SEC says something different, what's in the federal is going to supersede what the state says. And that's why this is nice, is because you can offer it to people basically all across the country. There might be some states that are excluded. So before you get really excited about something, check to make sure that investors in your state can be included. And the reason they might exclude some people from some states is because some states may have some laws that are just too much of a pain to deal with, because each of these states right here needs its own little supplement. You can see how many there are. And if your state is one that they don't want to deal with because it's too expensive to get this written, or your state has extra reporting or just extra rules that the issuer doesn't want to abide by, they may just exclude people completely from participating in a security. It's not often. Texas and Florida, there are a few others that are difficult to deal with. Wisconsin, Washington, that just tend to be a little bit more difficult to deal with. So if you live in one of those states, you just want to double check that you can be included. Evan says, is the club able to hire a lawyer on its behalf where we pool money as a group? Or I think I heard you say this, we as individual investors must do our own individual due diligence. We actually hired an attorney for our first club deal. He prepared our joint venture documents for us. And then he took a look at the PPM that we were investing in and reviewed it to make sure that they were compliant and that we were also being compliant with the SEC. And the club or the members that have invested in that particular deal, we did pay for that. So we will put in usually like $100 to $300 into our club's bank account so that we can cover those kinds of expenses. Now, we don't have to do that every single time because that template that he created for us, we can keep reusing and tweak it ourselves. But if we tweak it enough, we'll want to send it back to him. Or if we have something that we're just not feeling comfortable with, we could definitely send it to him. And the people investing in that particular deal would all just split the cost of that. Now, if the club, the members there, they feel comfortable with it and only one or maybe two members don't feel comfortable with it, it'd be one of those things where they would assume that cost for themselves. Or more likely, they would say, hey, I'd like an attorney to review this. And you just ask the club, like, can we split the cost of this? Because we're all going to benefit from that attorney review.
Cool. Thanks.
That's the nice thing about a club with a smaller group of people is we can negotiate those types of things. If we need to change the boilerplate or change the agreement, we can always do that.
Yeah, it seems like there's a lot of like leverage involved as far as being part of a club. Like powers and numbers come into effect. It's kind of nice.
Yeah, we definitely can go in and negotiate for better terms. Often that will come with a little bit of the GP so we can be more involved and protect the investment better. I would say that people who are coming into a deal as part of the general partnership, there is a requirement that those members have a legitimate reason to be in that general partnership, and raising capital is not one of those reasons. There are licenses and commissions that people who are licensed to raise capital can get. They can receive what's called direct compensation or commissions, either a piece of the equity or a cash payment. But people who are not licensed cannot receive direct compensation. And so the role in the general partnership for people who are bringing in capital needs to be a legitimate ongoing role, and investor relations often just does not cut it. So one of the things that we negotiate is, because we're bringing in a pool of cash, is we want more access and more voting rights, more say in what goes on, and certainly earlier notification that we can watch over what's going on in the deal. And for those of us who have more experience, we can actually offer advice, or we can say, hey, this is a great system. Do you mind if I share that with some of my other operators? We're just going to have better access, better understanding, and better control of the deal. And that's our ongoing responsibility, is making sure that this deal is being managed appropriately. So we're going to learn a lot by working with a wide group of people, but that's not why we're there. We're not in the GP so we can learn. That's not a legitimate reason either. We're there first and foremost to protect that investment. Mm-hmm. And anything else that we get out of it after that is going to be just a fringe benefit, not the main reason why we're there.
Right.
One of the things that I like to look for first here is just to make sure that this all agrees. Just read over, a lot of this is just plain English, so that you're going to have the fund, the purpose, and this is going to tell you the investing thesis, especially if it's a multi-offering fund. There's not going to be a specific property identified. They're going to open a fund so that they can raise money in a blind way. And you have to make sure that the deals that the fund is going to be investing in meet your personal criteria. It's going to be a little bit more broad, a little bit more vague, which allows the fund manager to be able to raise money and find a place to put it as they're looking for deals. It is a lot more difficult to raise for a blind fund, because you can imagine convincing people to put their money into a deal is hard enough. But if you don't even know which property they're buying, it's even harder. So sometimes you'll see something here where it might have 3 properties already identified, and your investment is going to be split evenly across the 3, and you will receive your return as an aggregate of the 3 properties' performance. Or it may be split up differently, that you can say, we're just going to make our percentage off of each deal individually, how it does. Some may even allow you to pick and choose which assets you want to invest in, but that's a lot more uncommon. So here's where you're going to see that IRR range is what they're targeting. So these are the words that you're looking for: targeted, expected, projected. And you want to make sure, if you're an operator, or if you're hearing an operator in a webinar and they're talking about how we're going to get 27 or 28% IRR on this is going to be such a great deal, but they're not using those words like targeted or projected, they can get into a lot of trouble if they are not able to then match that. Because even though the PPM says targeted, they still can't make assertions in the webinar or the pitch deck that are illegal. This is explaining the terms of the deal. This is usually a repeat of what's in the offering memorandum. Where to get a hold of people, where to reach out, like investor relations, the person who's going to answer all those questions. The person who's going to answer the questions is the investor relations specialist, but they often will have another job. Like, let's say they found the deal, or they are going to be in all the asset management meetings, because the investor relations is to protect the investors by participating in the management of the deal. But it's also their job, even if they didn't bring in that investor, it's not their personal investor, they're going to take care of all of the investors that any partner brought in. And so if you can negotiate a job like that in the GP, that's a needed position, very needed. What we don't want to see is that you're just investor relations and you're only over your own investors. That tends to be a red flag, because you went out and raised capital and you're only in charge of your own investors. Now, that's not to say that people can't be in charge of their own investors. That's often done. That just can't be your only job. If that's your only job, find something else, negotiate something else, position yourself in some sort of a way that you are valuable in there, like serving all the investors, something like that. So the minimum investment is 100 units at the purchase price of $100,000. That doesn't mean that this is a legal minimum. These are the terms. They can approve a lower amount, especially in a 506C where they have unlimited investors. They often will approve less. And people ask that, can I put in less than the minimum? And of course they're groaning like, oh, because they're raising $25,000 at a time for 4.6. They can take less. If you are raising in the club and you want to bring in a limited partner once we're in the general partnership, they may ask you, oh, do I have to put in $100,000? So make sure you ask the operator up front when you see what the minimum is, if it's possible to come in under that. Typically on a 506C, they will say fine. If it's a 506B, they'll say that's fine if they are accredited. They don't want non-accredited or unaccredited investors taking up a space. You only get 35 of those in a 506B. And if they're taking up one of those 35 spots at, say, 25,000, they're just going to get moved to the bottom of the waiting list. And if it's a deal that's either a really good deal or an operator that's very trustworthy, they may just get waitlisted and they might not make it into the deal. So it's not a legal minimum, but you definitely have to get permission to invest less. This is just defining all of the terms here. You're going to see this over and over again. Again, the fund offered limited number, prospective investors. A lot of this is just very repetitive, but it's not. This isn't difficult reading here. So just go ahead and read your way through these until you get to something that you don't understand, which then you can highlight. You can ask somebody in the club. You can consult an attorney if you're not in the club. The club is free, so you should just be in it. Now, here's where you start to see that there might be some things that you need to pay attention to that might be a little bit different. The fund will use its best efforts to ensure that the aggregate amount of all its indebtedness does not exceed 80% of the fair market value of its direct and indirect assets upon stabilization. So not what you bought it for, but what it's going to be worth when it's stabilized, which is typically more. So if you get a loan that's maybe 75% of what you paid for it, you can take on extra debt, which in a market like we have today might be kind of difficult, but they could take on more private lenders. They could take on second tier debt or second lien debt, mezzanine debt is what they call that. They could take on loans from the shareholders, and that's what this capital call is going to refer to. So each member is agreeing to make capital contributions up to the amount of the member's commitment. So the $100,000 in this case. Let's say you're buying one minimum unit. And then in addition to a member's capital commitment, at any time after the final closing of the offering, the manager may issue one or more capital calls to the members. So this is just an overview. They're going to go into more depth on what that capital call looks like. So you can just look in the PDF and use the search feature to type in capital call, and it will highlight where all of those occur. So you're going to come down here, you're going to read the details of what these capital calls could look like. This is one of the first red flags you're going to look for. A capital call just means that for whatever reason, they've run out of operating capital and the property's not doing well and they need an injection of capital in order to continue to function. You want there to be some ability to call capital, because otherwise, if they get in trouble and they can't make the mortgage payment, then the entire thing could be foreclosed on and your investment will be going to zero. That is one of the only ways that your investment can go to zero if the loan is for some reason defaulted. There are some other things like, for example, you have a hurricane and your insurance isn't correct. That could make you lose the whole thing. So there are other things, but this is the number one, the most likely. So if they don't have the ability to call in extra capital, if things are going south or not going well, then you're at more of a risk of losing the entire investment. You don't want to see that the capital call is too limiting, though. You want to make sure that you can be able to respond, because if you don't, oftentimes there's a dilution, and you want to see how much that dilution is. Because if they're bringing more capital into the deal, it's kind of like splitting shares where each of those shares is going to be worth less. So one of the things they're going to do first is they're going to exhaust all other efforts. And that's why that debt thing up above was important, because they don't want to go over 80%, because they don't want to have a capital call. It's bad customer service. It's bad for business. You're going to tell everybody on social media, or your friends, don't invest with them. I had a capital call. It was terrible. They want to avoid this at all costs. And this is why the operator is the most important part of this deal. Because if they feel like they can hide things in the PPM and they can get away with stuff, they're not in this for just one deal. They want repeat investors. The amount of work that we do to get one investor is so much more than the amount of effort it takes to retain an investor. Probably 10 times the amount of work to get a new investor than it is to retain an existing investor. They don't want to do things that are going to make you mad or make you dissatisfied. So you want to see what are their options before a capital call. So in addition to the member's initial subscription at any time after final closing of the offering of the units, this means the subscription is closed, not necessarily after the property is closed. It just means once they can no longer accept money, because they can only accept $4.6 million, right? But what if they end up needing more than that? What if they misestimated how much they were going to need? They need to get more in. They may, in the manager's sole discretion, require all members, other than the managers, to submit to one or more capital calls in the aggregate of up to 10% of the capital commitment. So if you put in $100,000, it's only 10 grand, up to 10% of that capital commitment within at least 10 days of the capital call being made. In the event that a member fails to make any required additional capital contribution, then the other members may, but will not be required to, make a loan to the defaulting member. Each such loan is a contribution default loan. And because it's in quotation marks, you know that that's a term that they have defined, and they're basically referring back to it. It's like buyer and seller. They define what those mean, and then they'll continue to use that term throughout the rest of the legal document. So each such loan is a contribution default loan by funding the other member's pro rata portion of the defaulting member's unfunded capital on its behalf. So if we were in this deal together as club members and they had a capital call and we each had $100,000 in there, and each of us had to put in $5,000 or $10,000, some of the people in the group might not be able to do it for whatever reason. Now, I would say that not being able to do a 10% on a $50,000 to $100,000 capital call, if you're unable to do that, it's either bad planning. You should have an emergency fund for every investment that you do. Now, this emergency fund is saying have 10 grand available to you just in case throughout the life of this investment. And it's telling you exactly what your emergency fund should be. One capital call is very unusual. Definitely ask the managers if they've ever done a capital call. And if they have, get the details and the story behind it. It happens. It doesn't happen very often, and it definitely is a last resort. But if it ever has happened, you definitely want to be asking that question and what it looked like. Now, I've had the answer like, we've never done one. So if we need to, we don't know what that's going to look like because we've never done one. We don't have that experience. And that's a legitimate answer if they've never done one. But what it could look like is what the PPM says. Obviously, they're going to want less. They're going to want to do other options first. And then that loan, you're going to want to see the terms of that because it may be pre-negotiated what that interest rate is going to be. And if somebody makes a loan on your behalf, then you have to pay that interest rate out of your returns and your proceeds, because that loan will have to be paid off typically first before you start receiving any profits. So have an emergency fund. If for whatever reason life happens, you get divorced, you get sued because you hit somebody with your car and you're in a wrongful death, you have to declare bankruptcy, and every asset that you have has to go to an ex-spouse. Things happen. You know, your kid can get cancer and your medical bills are suffocating because your insurance doesn't cover what you thought it was going to cover. Or maybe another property went bad and you're pouring everything into it and you've just really depleted down your emergency fund. Then you need to be aware when you get that close to the wire financially, you need to look at every single investment that you have out and think to yourself, okay, if these all call, because usually what happens is when they call, it's because the economy's bad. So it'll be going great. None of them will ever do anything. And then suddenly something really bad happens like COVID and the whole world is suffering. And you may start to have multiple deals struggling at the same time. So when it rains, it pours. So look at these deals, figure out how much you need to have available to you in case that capital gets called, and find out, especially if you're in the club, you know who the other partners are. If you're just a limited partner, you don't know who those other partners are, and somebody may be making a loan, you don't even know that person. So this is one reason why limited partners actually good, because you don't want to be able to take this over and suddenly have a bunch of business partners that you didn't get to choose, that you didn't know who they were. So that's why being a limited partner sometimes is an advantage, because you don't have to talk to them, work with them, have anything to do with them. But just make sure that you are able to pay this, or you at least have some sort of a backup plan, a credit card, a line of credit, that you talk to your friends and family like, hey, I'm in a bad space, or talk to your fellow partners if you know any of the other investors and say, this is going to be bad. If anything gets called, can we work something out? And then definitely tell the operators if you're going through a tough time. If you feel like the property might be struggling, I just want to ask what's going to happen there. If you feel like they might do a capital call, you need to be prepared. It can happen. All right, let's go back to these questions that we've got in the chat. Raquel says, how many non-accredited investors can invest in each 506B? Is it dependent on the size of the raise or the sponsor? It's always 35. And a lot of 506Bs won't allow any unaccredited investors because they don't want to deal with them. The extra disclosures that need to happen, the audited financials that are required if you have unaccredited investors in there. A lot of them will just do a 506B, but still only just their rich friends and family can invest, just because that's the easiest, cheapest fund to create and to administrate. And just the least amount of disclosures, the least amount of reporting. And so it's 35, but the PPM sometimes doesn't even allow for those 35. All right, Marcus says, securities may not be sold to more than 35 non-accredited investors. All non-accredited investors, either alone or with a purchaser representative, must meet the legal standard of having sufficient knowledge and experience in financial and business matters to be capable of evaluating the merits and risks of the prospective investment. Now, that's the difference between an accredited investor and a sophisticated investor. A sophisticated is not accredited, but they do have some sort of business knowledge that makes them feel confident that they can invest in this type of thing with some degree of knowledge and experience. If you have run a small business, you have a business degree, you've invested in some other things, your family business, and when you sign the subscription documents, they'll ask you, are you accredited, are you not? And if they're not, then you'll check that you're sophisticated, and there might even be a blank that you have to fill in on why you think that you are qualified to do this. I've seen them before where it's like, hey, this is my third syndication as a limited partner, because they've done this a couple of times before. I've seen where I have a business degree. All of that's relevant, whatever the reason is, but you may have to put that on your subscription document. Let's pause here for a second and talk about what you will need to sign. The PPM is one you'll need to sign. The other thing you're going to need to sign is the company operating agreement. Because they're creating an LLC for this property to go into, they will have an operating agreement that you will need to read and sign. It's oftentimes included in the PPM. Sometimes it's two different documents. The third thing you'll need to sign is a subscription agreement, where you put your name, the entity you're investing in, how many units you want, if you're doing Class A or Class B, if you're doing it through a self-directed IRA, something like that. And it'll just be a form that you fill out so that you can basically state what your custom or your individual commitment is. The PPM is just a blanket. You're just going to read it. You're going to sign it. You're not have to fill anything out. Any questions on that? Mark says, I recently invested in a Nashville syndication firm. Although I did some, I probably could have done more due diligence. Is there a logical way I could speak with others who have experience with that same operator? So you're a limited partner and you're asking to meet the other limited partners so that you can find out from their perspective how the investment is going. The only way you're going to be able to find them is if the operator discloses who they are. If your operator is going to do some sort of a Zoom call, you might be able to meet some of the other limited partners. But one of the reasons that it's so great to be a limited partner is you don't know who the other ones are. They're not controlling the deal, and you don't need to know who they are. What I would do is call the operators and ask for some references. You'd like to invest in another deal with them. You've been really happy. You'd like to talk to some of their referrals. If they don't have any referrals, a lot of those partners want privacy. They don't want to have their information disclosed. They don't want to have 50,000 phone calls a day if they're, hey, will you be a referral for us? And they might say, sure, I would be, but then they're getting tons of calls. And so references are really not all that effective, I found, and they're difficult to get. So what might be a better fit is to ask for some of their professional references, to talk to their property management company, to talk to maybe their accountant. If they have anybody else they can refer to you, that would be where I would start with that if they're not doing any sort of quarterly meeting. Don't put more of your wealth into a deal than you can tolerate how much you're missing. Because when you're buying a stock, you don't have any control. And you're not going to understand everything because you're not privy to those meetings. Sometimes you don't have deep, intimate knowledge of what's going on in the business. That's normal in securities. And that's why there are so many disclosures of what they can and might be able to do, is because you don't have any decision-making authority and you don't even have access to all of the information. You just have to know what the risks are and that you're only putting in so much that you can tolerate. Some types of funds have a net worth limit. So if your income or your net worth, you may only be able to put in, say, 10% of it. These types of funds, 506Bs and Cs, they don't have that kind of limitation. But I would make sure that you hold that to a certain percentage of your liquid investing capital so that you don't have so much in one deal that if something goes wrong with it, it would be really devastating to you. I know people who want to get into a general partnership, and to buy your way into that as an accredited investor, you probably have to put in between $300,000 and $500,000. Just make sure that you have more than that. And so it's tough. It's tough to buy into that. And so you want to make sure that you're spreading yourself around. And then once you know what's going on, maybe you'll sell a property and you'll get maybe 2 properties in the same year and you end up with $250,000 or $500,000 and you want to take all of that and go invest it in one general partnership. I would just make sure that you have something else left to invest in case that one deal goes wrong. Now, this here answers the question of liquidity. No member may withdraw from the fund without the manager's written consent. The manager has sole discretion to withhold that consent. You can sell your limited partner shares with the agreement of the sponsors. These are not considered liquid investments. Once you put your money in, expect to have it tied up. If you need that or you think you might need it, it's best to only put in as much as you can tolerate being tied up. Now, it could be tied up for 2 years until they refinance. It could be tied up for 5 to 7 years if they are not going to do a refinance. You'll start to be getting distributions, but you're not going to get your original capital back typically until it's sold or refinanced. On the type of deals that we tend to look at, there are deals that focus more on cash flow, where you're going to have a stronger cash flow throughout. Maybe it's a really nice property and it's cash flowing from day one, so the returns may not be as high, but you're going to be getting distributions, higher cash flow early on. And so you just have to decide, am I okay with this? And some people are not. This is not something that you can put on your liquidity statement if you're trying to apply for a loan. You can put it in as an asset, but it certainly is not a liquid asset like your stocks would be, or even your crypto. All right, this is one thing people ask about a lot: the books and the records. Members or their authorized representatives shall, at all reasonable times and for any purpose reasonably related to the business and affairs of the fund and their interest therein, have access to the fund's books and records. Limited partners often don't understand that they have this right. I want to see the books. You can ask, and it says right here that they have to reasonably show them to you. You have to have some purpose for asking for it. But if you feel like that things are not going well, that you're having any kind of suspicion and you just feel uncomfortable with it, you're going to want to ask to see some sort of profit and loss is what I would ask for. But you also don't want to be one of those investors that is scared and annoying. You don't want those operators to have to babysit you. You need to be able to make decisions. You need to be able to use the information that you've been given, and that you need to have a good reason to ask to see those books. If you're feeling like there's some sort of fraud, embezzlement, or maybe the property's not going well and they're trying to cover it up, you have the right to look at it. But I would make sure that you only use that right if you have a good reason for doing so. And this tells you how the accounting is going to be done. The financial statements will be prepared. The close of each taxable year, they're available. They will give you some sort of a K1 so you can give it to your accountant. That should be done sometime in March. Oftentimes they are not. They'll go into May, June, maybe even July. We've got 2 deals that I'm in right now where we still don't have K1s just because of the accountant shortage that we're dealing with right now. That's not normal. But if you're in a time where they're not having those kinds of shortages and you still don't have your statements, then yeah, I might want to see the books, figure out like what's going on here. Because if they're doing something abnormal, that might be a red flag. All right, Mark says, likely they will point me toward their most satisfied investors. That's another good point on referrals, Mark. They're not going to point to the ones who they fired or who aren't going to invest with them again. So I think the professional references might be a little bit better. And their online reputation is going to be important. because they may not have a securities violation. They may not have done anything illegal. They may just be running a deal that's not going well. And everybody's going to have a deal that doesn't go great. It's usually 2 or 3 things that will add up and just the deal starts going downhill because it's not usually just one thing. I expect it. If I have enough investments out, one of them is not going to perform and I might lose money on it. And it's not just my deals that I'm in as a limited partner. It's just the way it goes. If they have unhappy customers because the deal didn't go well, it may have been out of their control. It may not have been. So what you're trying to identify here is fraudulence or incompetence. Evan says, can I sell a property in a 1031 exchange and use those proceeds to buy into a GP position? Yes. It depends on the operator. They usually will set thresholds for that. They will say it's a $300,000 minimum or a $500,000 minimum. And the reason why they do that is because you can't just go in as a limited partner. You're actually in a joint venture. It's called a TIC, or tenants in common. And you will actually form some sort of a joint venture or TIC agreement between you and the operator, which makes you part of the GP. So if you 1031 into a syndication, typically you're part of the GP because of that. Now, there are funds that specialize in 1031 funds coming in, and they're able to place that without you having to be a member of a GP. You might have a TIC with other investors. There are lots of different ways to structure that, and some of the larger funds have some pretty creative solutions there. But yes, you can do it. You just have to make sure that you're allowing that you have enough to meet the minimum. And you, on a 1031, you have to take all the money that you made, your gains, plus all the original cash that you put in. I couldn't just take the gains out and reinvest those and keep the original money I put in. I had to put it all in, and it had to go in one deal. And that's why sometimes a 1031 can be kind of limiting, and why some people like to use it as a TIC to go into a GP, because they have to put it all in one deal anyway. If it's 300 or 500K, it's like, it doesn't feel as risky when your options are more limited. So that's why I think a lot of people want to take large chunks of cash like that and buy their way into a GP. It's a good question, and it comes up a lot. So just talk to the operators. They all have a slightly different way of dealing with it. We're actually through the most important part, except for the fees, is what I wanted to end in. That's why the search feature on these PDFs is so nice, because you can search for some of the red flags that you think are really important. And you should still read the whole thing, at least skim the whole thing, but there are certain things that you should be looking for. This deal, like any deal, is going to have fees. And you want to make sure that those fees that they can take are reasonable. Now, the fees that they disclose that they're going to take in the webinar or in the offering memorandum are the fees that they're planning on taking. The PPM will often allow them to take higher fees than they've stated they're going to take, and they may be able to invoke that. You might want to ask if they plan on doing that and get it in writing. Ask them in an email. One thing that operators hate is when they get tons and tons of questions from their investors, super nitty-gritty questions, and they know that they need to answer them and make everybody satisfied. So one thing you could do is just record yourself asking those questions by voice, and they can just send it back to you. It's almost like a phone call. I prefer that for a lot of reasons, because then you have a recording of their voice saying it. That helps with the credibility if they go back on what they said, that you have that record. And I usually will send those voice recordings through an email. And sometimes I'll write out the list, like, to clarify, here's what we said over those voice recordings. Now, they're going to say that the target return is 28% net of the fees and expenses. So they're going to pay those fees and expenses, and they're going to make 28% after that. And that's important, because sometimes you'll make 28%, but then they take their fees out. That would be a tricky thing somebody would do. I've never seen it. It's just one thing you need to be aware. What they're advertising is after fees and expenses. You're also going to want to find out what types of fees and expenses they can charge. There's a list here where it talks about these types of fees being used to pay for legal advice, accounting, like, it's all normal expenses. What they are is non-operating expenses, because my accountant might be more expensive than somebody else's accountant. My legal issues might be different. Let's say we have a TIC partner in there and those legal expenses are going to be higher. That's another thing. If you're going to do a 1031 and you're going to TIC, usually they'll make you also pay your own legal expenses, because your document needs to be drawn up and it's different than the documents they already have. And that's not cheap. It's usually $10,000, $15,000 to draw up a TIC like that, to partner with a syndication. And sometimes they'll just ask you to pay that so that the other investors don't have to assume that legal fee. You're going to see that they can charge a development fee, an asset management fee, asset acquisition, construction oversight, asset disposition, And sometimes they'll even have a refinance fee. It's a lot of work to get a property ready to get a new loan, especially if they're getting a government-backed loan. I think our Fannie loan that we did had something like 75 forms. But we actually had to hire an executive assistant to help us fill out all these forms. And they were really detailed information, like where does every tenant work and what's the income of every tenant? They were wanting a lot of demographic information, which of course the government's always going to want, but we need help just to fill out the forms. And so it's a lot of work to get a property ready to sell or to refinance. And sometimes they will charge a fee just because they need to get reimbursed for the time that they're spending on these. So just make sure you know what those mean. Are they planning on collecting them? And the offering memorandum will tell you what they're planning on doing. So there are a lot of other terms and things in here that we are going to want to go through, but the main point is to feel like you're capable of reading this, that you're entitled to legal representation, and if you're investing in the club, that we review this together. Raquel says, are there any red flag fees? For me, the fees that are red flag is if they're going to take all of them and they're going to take the maximum of what's normal in the industry. I haven't seen that, but some deals have higher fees than others. And if it's a deal where the general partners are not actually making that much money, you need to make sure that there's a nice balance where you're going to make money and the general partnership is going to make money. And you don't want them making money off of the fees. I'll give you one example where the construction management fee was going to the general contractor, who was also a general partner. Now, they do need to disclose in there if any of the general partners either are going to be doing work for the deal, like say, for example, you're a commercial insurance agent and you're going to issue the policy, that needs to be disclosed in the PPM so the associated people or the people who they're going to hire to do it. And sometimes one of the partners is a commercial contractor and they're going to collect not only the fees from doing the job, they're going to get a management fee for being in the GP. So they're basically double dipping on those fees. That makes me very uncomfortable. I want to see that they're going to disclose that they're going to have those jobs bid out and the best bid will win. I don't want everything just awarded to the contractor because they might be more motivated for change orders, cost overruns, and they're going to make money through their construction company, and the performance of the property isn't as important. Same thing, like I said, for insurance agents. If you have a partner who is a commercial broker and is putting their commission back into the deal as part of their equity, or are they going to take a commission off of it, especially if it's off of the sale of the asset a few years down the road, you want to be aware of the jobs of all of these partners. Not just the asset managers, because it could be like a capital raiser who has a smaller management, but they might have some sort of job where they're going to make money off of this deal, off of a fee. So those are the red flags that I would watch out for. How high are the percentages? Are they taking just a few fees or are they going to take all of them? The aggregate fees shouldn't be higher than a certain percent. Let's say 6 or 7% of the deal shouldn't be more than that in fees. And that the people that you're dealing with are not going to be making their money off of those fees, or most of their money shouldn't be off of the fees, and that they're not going to be making money in another related peripheral professional capacity that might make them more motivated by, say, selling it down the road than they're going to be. And you would say, okay, if they're selling it, they want it to be worth as much as possible, because the more it's worth, the more they can sell it for, the more commission they're going to make. So it's not necessarily something, oh, I wouldn't do it because this broker is going to make money off of the sale. But it needs to be disclosed, and you need to be able to evaluate if they're motivated by fees or if they're motivated by performance. But we do have a ton of these resources in the club. Every deal that we've ever done or considered is in the archive folder. Deals that we contributed to are in the funded folder. You can look through all the PPMs, all of the spreadsheet pro formas, pitch decks galore. It's a lot of material, and we've looked at pretty much all of it and accepted or rejected it. A lot of people in the club that you can say, hey, I see this is in the archive. Why didn't we do this deal? It looks pretty good to me. Either we didn't have the capacity or we didn't like the deal, and here's the reason why. So lots and lots of good information in there. If you're somebody who can force yourself to dig into the documents, it can be a little bit boring. Service providers, use of professionals. This is kind of where you have funds and affiliates. For example, I know two of the sponsors on this are attorneys. So they would say if they were doing legal work on behalf of this property, they would disclose it that they were doing legal work. But in this case, they're not. Like I said, this thing is 120 pages. You need to read the whole thing. And there's some good stuff in here. You're going to learn a lot. You're going to ask a lot of questions. Don't let this scare you off from doing the investment. If you trust the operators, see, here's where the pitch deck is. They put that at the end. That's part of it. We've already seen this. So it's 120 pages, but a lot of it's the company agreement or the offering memorandum. You see how this is included in their legal disclosures. That's why everything you say can and will be used against you if there's some sort of a dispute. We're going to wrap it up. If you have any more questions, jump in the Slack channel and just post them in there. We're going to continue the conversation. And next week, we will see you back where we're going to cover the investing portal, the IT and the software part of it, how you actually wire money over there, the documents that you can expect to be reviewing quarterly as they send out reports, how you can raise money if you're part of a GP or general partnership. You can go and raise additional capital from limited partners. You can work your way into deals if you have some experience and you can raise some capital. That makes you very, very valuable. So we're going to go over some strategies for raising additional capital from your friends and family or your network. We're also going to go over how you can free up more of your own cash to invest, raising cash and being a responsible steward of the investments that you've made. So how to track them all if you have multiple ones, and also how to track the individual data within one. So we'll be spending a lot of time in the Syndication Pro portal next week while we go over all of that. I appreciate everyone for coming. Like I said, if you have any extra questions, just jump in the Slack channel and ask them there. Have a good night, everyone.
Good night, Emma. Thank you.
Thanks for coming.
Good night.
Thank you.
Thanks very much.
Yeah, Mike, happy birthday.
Thank you very much.
Thanks.
Thank
Night.
you.